All right, more breaking economics news. The final report on second quarter GDP. Kevin Ferry of Cronus Futures is with us. Steve Leisman is in Washington this morning, and Bill Rogers is with us in studio with Jason Trenner. What are the numbers?
Unchanged, Joe. GDP, no change from before, right on the expectation. Core PCE also coming in at 2, right where it was reported. The consumption number is a tenth better. We're looking for down 1. It's in at 9/10, down 9/10.
Kevin, knowing traders as you do, is there anything that they would key off of here that raised an eyebrow with you?
Joe, they're really already moving on to the next one. This is all about how much. Obviously, I think traders thought that this could print positively, so the zero number is a little bit less than what traders were looking for, but they'll be looking for this to balance out into the fourth quarter. The trade is all about the fourth already.
Yeah, he's got it wrong.
All right, let's get more reaction from who we have sticking with us, Kevin Ferry. We got Steve Leisman as well, Bill Rogers, former Labor Department chief economist and Rutgers University professor, and our guest host, Jason Trenner of Strategas Research Partners. Steve, anything that caught your eye there?
Well, the top line is catching my eye. Double check me on this, Joe, but I got minus 0.7, so it's quite a bit better than originally.
Hey, Steve, that's 0.7 on the top line. That's right, down 0.7. So it's better, about 4/10 better than the average.
Better than expected. And plus, the expectation was for it to be worse, or minus 1.2. So I think that it's quite a bit better. So I'm trying to see where it came from. I believe the consumption numbers were a little bit better, and maybe we didn't pick up the inventory drawdown that had been expected. I need to do a little work on this right now, but the top line number is better than expected, minus 0.7, when economists are looking for minus 1.2.
All right, that would account, Steve and Kevin, for the equities. This is a friendly number for the stock market, I guess, right?
That's right, Joe. I mean, we were looking at the bottom. That's right. Steve's right on the top. So, but it's not going to change people's focus now on going forward. What's the earnings season look like? What's the fourth quarter going to be, better or worse? But at least it's a marker that's a little bit higher than we were looking at.
What do you think, Bill?
Question for Steve. Do you know what if the number on government consumption expenditures and gross investment stayed at a 6.4% increase?
So government consumption expenditures a little bit hotter, Bill. It was 6.7, with the federal government being 11.4%. So I think that was a little bit more than expected, which may mean they got, I don't know, either a little more deficit spending and or a little more stimulus spending out the door in the second quarter. I've always found it curious, Bill, you having been in government, why the government can't count its own spending, but that's a story for another day.
I agree with the comment earlier that the market, I think Main Street, people are looking towards Friday. This is a great number. It sort of affirms what we had seen, sort of beginning to slow down, edging towards recovery in the second quarter. We're moving on.
I want to get Jason. Jason, do you think that this is another little scintilla of information for the half-full crowd to use as a reason to to keep buying these stocks at these levels?
The valuation, the hard part right now, Joe, is that I'm convinced that by the end of the year, you're going to see a headline that says the Obama economic miracle. Because by the end of the year, only a third of the stimulus will have been spent. You're going to have 2/3 of it that's going to be spent next year in 2010. And GDP growth, real GDP growth, will probably be in the 3 to 5% range for the second half of this year. So I'm kind of dancing around your question. I think a lot of that has been discounted already in the stock market. But by the same token, people are not going to know whether this is real or whether it's ephemeral, whether it's just driven by government spending or whether it's the start of a new cycle. My own particular feeling is that a lot of this is what you're going to see is driven by government spending. This isn't a typical cycle. It's driven by pent-up demand for durables. And so I think I wouldn't stand in front of the stock market now, but I would start to get very nervous in the start of the new year.
All right. Make it fast.
Well, just watch the currency markets, Joe. Dollar was really getting beat up this morning. That was helping the stock market. There's been some quick adjustments about halfway back, right before the numbers. So watch the level of the dollar the rest of the session.
It's good advice. Yeah, because we were at 89. Yes, Steve?
Just a quick thing on the Fed stuff. We've had the hawks speak, right? We had Plosser out there. We had Fisher, who's sort of a moderate hawk. Today, watch for a little more dovish talk from the Fed guys. We have Lockhart coming out and Cohn, which is one of the reasons I'm here for the Shadow Open Market Committee meeting. So we might get a reversal in whatever the way the market was leaning relative to what the Fed was saying. Might come back this way where they kind of redirect maybe back towards the more dovish statement, which came out last week.
Okay. I want to thank everyone. Appreciate that, Steve and Kevin and Bill. And you're going to be with us, Jason.